so that we can add them to our community space in Bridge for Billions, and so that people that could not join today for any reason can recap and watch them later. So I just started the recording, and you are all muted. So if at some point we open for discussion or you're asked to intervene, just remember to unmute yourself before you speak. But during the session, I will ask if you keep muted, just so we don't have any background noise or interference. And for those that don't know me, I'm Alex. I'm Alex from Bridge for Billions. We're here on the second session of our investment online series. This is a series of events that we asked partners like Sebastian, who is actually one of our mentors, and others who are experts in investment and who deal with early stage founders daily and from different geographies, different areas of innovation, so that they could share with you guys all the tips and expertise for those that are starting this fundraising journey. We are doing this so that you could have a possibility to educate, to be more aware, to test, to network with people that are in the same stage and in the same journey as you are. So I really want to thank Sebastian to join us today. He will be telling us about the first steps. So why are we raising capital? What does it mean for my venture? Who should I target? So how do I do these first steps? And I welcome you to share in the chat any questions that you may have, anything that you would like to know. And at the end, we'll leave some more time for Q&A. And we can make this session as useful and joyful as we can do. So thank you, Sebastian. I'll handle the session to you, and I'll be here if you need anything.
Awesome. Thank you so much. So just to confirm, everyone can hear me. If you can give me just a quick thumbs up. Awesome. So first of all, it's a pleasure to be here. It's really exciting to be able to chat with so many entrepreneurs from all around the world. So, you know, I definitely welcome your questions, and, you know, like Alex said, we'll go through the presentation, and in the end, we'll leave some time for you guys to ask anything you might want. So just before we start, a quick intro. Who am I? So you guys know, my name's Sebastian. I'm part of the investments team here at Seedstars, where I'm an analyst. And really, you know, why am I here talking to you about your fundraising strategy? What's kind of my experience in this space, and why do I think I have something to add in this topic? Well, at Seedstars, we really work, you know, as ecosystem builders and investors in over now 80 cities around the world, specifically with startups in emerging markets in the earlier stages. So we know a thing or two about working with startups. Really, our goal is to help these entrepreneurs change the lives of people in emerging markets through the use of technology. And in order to do so, we give them support, including creating events, creating different programs, such as our Seedstars World Pitching Competition. And also, the part where I'm at, we also run an investment fund where we actively invest in startups all around the world. As of today, we have a portfolio of 59 startups with which we engage at their seed stage. And we not only help them really by writing checks, but also help them think through the process of raising capital from outside investors, expanding to other markets, and et cetera. So just to give you a kind of little bit more info on Seedstars, we have over 250,000 people in our community, 81 team members, and we have a bunch of different mentors and ecosystem stakeholders that work with us. Now, I just want to, before we start about why it's important to have a fundraising strategy, I just want to walk you through a very common scenario that we see all the time, and which is, you know, very unfortunate. You know, all the time we see families say, hey, we just want to raise money. And my first question is going to be like, okay, why? And they just simply say, because we don't have any money. And I'm like, okay, how much money do you want? It's like, I don't know, as much as you can give me. We don't really want to do this ever again. And then, you know, at that point, I start getting a little bit worried. I say, okay, who else are you raising money from, or why are you coming to me? The answer is, you know, just from investors, anyone who can give us money. at this point, I'm just like, okay, how's that going? Are you being able to raise that capital? And normally the answer is like, I don't know. We're talking to several investors, but we really, haven't closed anything yet. So what's wrong with this? For me, it's very clear. There's just no plan or structure around their fundraising. They just expect investors to, come knocking at your door and write you a check. It'd be awesome if we worked like that for founders, because we know that all of you founders are super busy and you guys are building stuff, and it's incredibly important. But unfortunately, if you're not controlling the process, it's going to be very hard to close a check. So that's where a fundraising strategy comes into place. So what's a fundraising strategy? It's nothing more than a plan on how you're going to go about raising funds. It's, if you think about it, when you created your startup, you didn't just show up to an office you rented one day and say, okay, I'm going to start building a startup. You probably created a business plan. You thought about, okay, what's the market opportunity? What do I want to do? Why do I want to do it, etc. And then you set up on starting your entrepreneurial journey. It's the exact same thing with fundraising. A fundraising strategy is essentially a business plan, but specifically targeted around your fundraising. It could be a very simple, short document. I know sometimes people create business plans that are, 40, 50 pages full of text and graphs. That's definitely not needed. But I think what's important here is just to make sure that you have a well thought out plan. And that's what we're going to talk about today, how to create this specific plan and what questions you should be asking yourself. In talking about questions, you really only have to answer 5 easy questions. The first one, why are you raising capital? Then from who are you raising that capital? How much capital are you raising? When will you raise this capital? And then finally, how will you go about raising these funds? If you guys are confused or don't know exactly where to start, well, that's great, because we're going to walk through each of these different steps. And it's hopefully by the end of this session, it's going to be very clear. You're going to be able to, sit down and write out that fundraising strategy and start hitting the phones or the emails to start raising some capital. So the first question that I like to start with is, why are you raising capital? And I think, sometimes people just say, okay, we just want to raise capital. I need money. But in reality, if you think fundamentally, why do we accept the fact that startups, need to get investors so they can be successful versus, other traditional businesses that, just grow slowly over time? And I really like this graph because I think it really drives home the point of what you can do with investment capital. In reality, raising investment funds, it's only a way to fund temporary negative cash flow as a way to power your growth. So if you see in this graph, we're seeing 3 different, growth strategies. I want to highlight the orange line, which is essentially trying to get more customers per month, initially at higher costs. However, when compared to the other strategies, which are just more slowly without burning as much cash, they all reach a break-even point at the same time. However, because you've acquired more customers, you can create a much larger sum of revenues. So essentially, raising capital allows you to grow faster and capitalize on opportunities such as, getting to market fast before your competitors, acquiring market share, capitalizing on a specific market opportunity, etc. Now, what are some bad reasons on why you want to raise capital? Simply, not having capital or because you're going to go out of business is not really a good reason. Think about it from an investor perspective. Why would I put in money, in a company if there's nothing that's going to change and it'll probably be in the same situation in a couple months? And just thinking sometimes, it's just what startups do. We all see, the news. It's like, this company just raised a couple $1 million. They just raised a Series B, a Series D. It's exciting, but there has to be some reasoning around it. So when you ask yourself this company, remember that investors fund plans. They don't fund capital shortages. What do we mean by that? Is that we want, as an investor, to know what you need this money for. And that's something that you should ask yourself as well. Some guiding questions in this process could be, what are you going to accomplish with this money? What are the milestones that you're able to hit? How is and I think fundamentally we should ask yourself is if you raise this round of money, how is your company going to be materially different than if you just, kept business as usual? Think about it. For me, you're not just pitching your business, you're pitching an investment opportunity. Because at the end of the day, that's how, as an investor, I can generate the returns I need to give money back to my LPs. Now, the why is incredibly important. Because if you don't know why you're raising money, it's going to be extremely hard to answer who are you raising money from, how much money you have to raise, when you should raise money, or even how you're going to go about it. It seems like an obvious question, but it really is what's going to determine, the other aspects of your fundraising strategy. And if you don't have a driving reason on why you want to raise this capital, it's going to be very hard as an entrepreneur to convey conviction on your idea and make investors come on board and really, finalize their investments. This is high risk capital. And if you're not telling me a reason why I should invest in right this second versus, in a year when I get to know a little bit more about your business, it's going to be very hard to close these investments. Now, the next question that we got to ask ourselves is, who are you raising capital from? And before we move into, what the different types of investors there are, et cetera, I think it's important as a company to also, be very realistic and think, okay, what is the market opportunity that I present? And why, what kind of investors do I think I can target? There's a myriad of ways where you can get investment capital. It's not just about getting, venture capital funds. You also have, a bunch of other sources of money where you could potentially, apply depending on your company. If you're having some sort of social impact or environmental impact, you can get grants. You could also, apply to government programs depending on the status of your company. If it's maybe not a tech startup, then you can apply for something like loans, etc. So don't think about it just, okay, I have to go out and raise money from venture capital investors. There's a myriad of ways to get money, and at the end, money is fungible. So it doesn't matter if you get $1 from a VC fund or from a bank. At the end of the day, it's the exact same type of money. Now, at the end of the day, the type of investor that you talk to is really gonna be determined by where in the life of your startup you are. So in the beginning stages of your startup, you're probably gonna have, to bootstrap and think a little bit about where you can get capital, maybe from your family or friends. It's at this stage, it's very, very early on. You probably don't even have, an MVP. You just have kind of this idea or this dream. And it's very hard to come to, a serious investor like a venture capital firm that has certain requirements that they have to fulfill to their investors and get money from them. So just being realistic and knowing, who to target is incredibly important. The funding is not one size fits all. Certain times, depending on the type of entrepreneurs, you're able to raise a lot of capital even before, you launch to market. Other areas, if you don't have as much experience, if you don't have as many connections, maybe you need to show some traction before. And then I just want to highlight that in general, the size of the checks also increases across this timeline. So your family and friends are probably going to be able, to give you maybe, a couple $1,000s, couple $100s to start your idea. But it's very unlikely that you can go to your family and friends and, raise a $10 million round. And if you can, maybe, introduce me to them or something. I have a few ideas here and there. But, as the size of the checks increases, so will other aspects of the fundraising process. So while you might be able to come to your family and friends and just, tell them a little bit about your idea and they'll cut you a check after convincing them a little bit, it's not going to be the same when you talk to an angel investor who's going to ask for certain documentation, such as, corporation documents or, your financial statements. So just be ready and be conscious of who you're targeting and make sure you're targeting the right people at each stage. Then I also want to highlight that as your company grows, it's more like you're more likely to be able to raise larger and larger rounds of capital. And what I mean by this is that you have to be honest on where you are in the life cycle of your company. If you're an idea stage company, it's going to be really hard for you to really raise a Series A because you're frankly just not there yet. So if think about this as a process where you don't have to raise all the capital right away. Rather, just set realistic targets and start raising bit by bit. And you increasingly, if you're successful, be able to access larger amounts of capital. Also, make sure you're targeting the right investors. If you are raising a pre-seed round and you go to a Series A investor, they're not even going to consider investing in you because you're not at the right stage. You might have the best idea ever, but it's just not a fit for what they're doing. Now, so we talked about this. We talked about the different types of investors, different stages. What should you consider when you think about, okay, who do I raise capital from? Think about the type of investor that you're targeting, and I think most importantly, who do you want as an investor in your company? Think about it. An investment is not just, you're not just going to a customer that you sell them a product and maybe you never see them again. An investment is not, especially in venture capital, is about a 10-year engagement. Think about what kind of people you would like to work for the next 10 years. And it's about much more than a check. Think about what are the strengths that you have, what are your weaknesses, and how can you complement them with people in let's say that help you beyond just writing an initial check. Are they going to be people that are engaged? Do you need someone that just is able to give you connections? Do you need someone that is able to give you guidance? Do you need someone that you look up to? It pays to be selective in this process. And there are certain guidelines on what kind of things you should be selective about or how you should filter investors. One is the type of fit, and we talked about stage fit, obviously. So if you're raising an angel round, don't go to a venture capital fund, go to angel investors. But there's also a bunch of different ways how you can find fit. Think about investors that invest in your sector or have experience in it, in your geography, by ticket size, etc. Like I said, don't waste time talking to the wrong investors because it's not going to go anywhere. And also do your diligence when you're crafting this investor list. You're making your Excel with all the names of the 20 to 25 funds that you want to talk to, or 100 funds you want to talk to. Make sure who are they? Is it just did you just Google VC investors and kind of copy pasted all the lists, or do you actually know what kind of companies do they invest in? Do they know what they're doing? Do they even have money at this point to invest, or they kind of just already invested all of their fund? And finally, finalize this list of prospective investors, because when you actually go out and execute this investment strategy, it's going to be very easy to go down the list rather than keep adding people all the time. Awesome. Then the next question that I want to raise is how much capital you want to raise, right? So we know now that I need money and I know why I want to do it. I know what kind of investors can give me this money. But when I go up and talk to these investors, I want to be able to tell them, okay, I want X amount of capital. And really, there are two theories, let's say there are two philosophies on how much capital you should raise. The left is what I call the just what you need philosophy, and the right is the as much as you can possibly raise philosophy. So on the just what you need philosophy, it's really thinking about, I just want money when I need it. I want to avoid, being diluted, because I understand that selling equity in my company is the most expensive way to finance myself. I also don't feel comfortable probably putting other people's money at risk. And I want to, I know that I only need X amount of money to get to the next point. And then when I reach my milestones, I can get more money. On the right hand is, well, how much can I possibly raise? And you might think, okay, we've been talking about milestone, that makes no sense at all. That's clearly the wrong philosophy. And I don't think so. I think there's really good arguments on why you should, capitalize on being able to raise capital. One is that you're likely to need more money than you think. It's really hard to forecast exactly what you need. It's always better to have a little bit of a surplus than a shortfall. And you also don't know when capital will be available again. What if your sector, goes out of favor and just becomes really hard to raise capital at that point? Or what happens if, there's a pandemic like the one we're living right now? Remember when the pandemic hit, a lot of investors stopped investing, And companies that needed money at that point in time exactly were just out of luck. And they were just, a lot of them were not able to raise capital and had to make big sacrifices or even close down. So in reality, there's no right or wrong answer. It's more of a personal decision. But I think it's important to be aware of the risks in each of these philosophies. On the just what you need philosophy, it might just not be enough. You might think you need 100, but really you need 110. And if you're falling short, then you might need to go out and raise more capital before you reach your milestones. And you might be unduly punished by the market. So because you didn't reach your milestones, you might even have to do a down round, or your previous investors might choose not to invest anymore in your company, and send a bad signal to the market. So there's danger in that. On the other hand, if you raise too much money, there's a big opportunity cost. You'll get too diluted, and if you run out of capital and might need to raise capital in the future, if you're too diluted for your stage, then investors might be hesitant to invest more money in your company. So what I like to preach, I guess, and from my side, is it's important to find the healthy middle. And how do you find this healthy middle? Well, remember the milestones that we've been talking about? It's important to just run the numbers. Don't pick arbitrary figures and really say, okay, I need 1 million, and that probably will allow me to get 100,000 customers. Run the numbers, use real assumptions, take your time to really find good price comparables. Future projections are never going to be perfect, and that's something all investors expect. But if you can defend them and show the logic behind it, then they're much more likely to support them. So you just have to understand, what are your cash needs? What gets you from point A to point B? And I also like to think in terms of 12 to 18 months. I think that's just a general, good practice in the market. Why 12 to 18 months? Well, that's only what we've seen in the market that's enough to build real value and reduce your risk. And if you think about the process itself of fundraising, think about it. Do you want to be doing this whole fundraising strategy that we're doing a webinar right now every 2 to 3 months? Probably not. You want to do it once, maybe last you like a year and a half, and you probably have to redo it once your company looks completely different and you've grown a bunch and you have other objectives. But that's much more manageable than having to come out every quarter and be knocking on investor doors. So if you give yourself enough time to really reach these milestones, it is likely that you'll be able to just have a natural progression throughout the fundraising process. Also, have let's say different levels of shopping lists. So know exactly what you want to buy with this cash. Have, let's say, your dream plan. What happens if I can raise $1 million at a great valuation? What are all the things I want to buy? What type of people I want to hire? What type of what's my marketing? How am I going to spend it? What kind of capital expenditures I'm going to have? But also then have a backup plan. What if I can only raise 750? How does that change my milestones, etc.? And here is the thing where I think that long-term thinking is pays in the short term, because you're able to really get enough funding to get to a point where you're comfortable in reaching your milestones, where you're not going to run out of cash, but you're also not selling too much of your company and kind of getting to a point where you reach your milestones and you still have a bunch of cash left, but you just diluted yourself way too much and lost personal value as a founder. So at the end of the day, like I said, no wrong or right. It's just about putting in the time, really thinking things through. And then just a quick note, this is about how much capital raising. Valuation is a separate topic, and unfortunately, we don't have time to really dig into it today. But come prepared. You think about, do a little bit of research on how to evaluate your company, talk to different investors, see comparables in the market. At the end of the day, valuation is always, a negotiation. And investors expect you to be over optimistic, but not to be, unrealistic. Now, we're almost, we now how much money you want to raise. but should just run out and do it at that point in time? Should just stop writing your fundraising strategy and say, okay, now I know who I'm talking to and how much I need, I'm ready? I think I really want to dig in the importance of timing in terms of raising your capital. And I think it just starts with one simple question: do you need money or do you want money? And I think it's it's one word of difference, but I think it makes all the difference. Timing is extremely important because when you're raising capital, you want to make sure that as an entrepreneur, you're raising capital from a position of strength. And what do I mean by this? Is that if you need money, you need to close this deal because you only have, if you don't pay your bills at the end of the month, you're going to close down your shop and you're going to have to solve your company. It's very unlikely that you're going to be able to, go through a long due diligence with an investor and even close a deal. And even if you're able to, you'll probably have to agree to whatever terms they give you and won't have time to really discuss them or reach a negotiation that's truly a win-win for both of you. On the other hand, if you want money, if you are able to sell an idea, if you're able to, tell investors, okay, this is why I want money at this time. I could keep going business as usual. My business is going well. I have money for a bunch of different months, but I think right now is the right moment to really top off and get, this next financing round that's going to be able to grow, 10 times as fast. Then you'll be really, giving yourself the time and the ability to get investors excited, to shop around and talk to different investment shops, to create competition for your round, and ultimately get a better deal for yourself. So when thinking about, when to raise capital, I think there's, 3 important things to think about. The first is that raising capital takes time. On average, what we've seen in the market, particularly in emerging markets around the world, is that on average, a financing round will take 6 months to close. So it's not like you can just, call the first investor and you're likely to get a deal there. It's a whole process, and we'll dig a little bit more about that when we talk about how it actually goes when you raise capital. But give yourself those 6 months to really raise capital. You can, get a great deal and get exactly what you want on your first meeting, then congratulations, that's awesome. You just save yourself a lot of time, but that's, to be honest, unlikely to happen. And you probably want to talk to a few funds, not just the first one that you talk to, because if you can create competition for your deal, then you're able to negotiate down and say, get the same amount of money at a lower valuation and dilute yourself less. The second point that I think it's important when raising capital is monitor your runway. So if you don't know, your runway essentially tells you how many more months do you have of cash in the bank to keep operating as a company. And the way you calculate it is that you grab your cash in the bank and you divide it by the amount of cash that you burn per month. So let's say if you have $100,000 in the bank, and that you know that to run your business, it takes, let's say, $10,000 per month, then you have enough cash in the bank to survive 10 months. It's also important to kind of make different scenarios with your runway. What happens, if things don't go according to the plan and my revenue doesn't keep growing? What if it just stagnates? What if it drops 20%? How does that change my predictions on the amount of time I have left as a company? Monitoring, how much money you have to keep operating is critical. And the worst thing you can do is, go to an investor and say, hey, I'm raising capital, now's the time, et cetera. And then they'll ask, okay, how much longer do you have? I have, a month or 2 left. It's going to be really hard to pressure them to close the deal because they know that they're holding the keys to the future of your company at that point. And then finally, which I alluded to before, and I think it's the most important part in terms of timing, is that you gotta convey what's your unique insight into the market. I think that the best founders are the ones that can convince investors that the time to invest is now. Because think about it from, let's say, my perspective as an investor. I might like a company a lot, but I've always want to have more information. At the end of the day, venture capital are very high risk investments. So the more information I can get before I make my decision, the better. So if I don't think your company is going to change between now and in 6 months or in 12 months, then I might take my time to really think about your investment, do more and more research, talk to your competitors, try to really understand what's going on before saying, okay, yeah, I'll put in some money so you can execute your vision. On the other hand, if as an entrepreneur, you tell me, hey, the time to invest in this space is now. Because the company, I can exploit this opportunity. I can do X, Y, and Z to grow, to increase my growth rate. And then what I'm asking myself is, okay, if I don't execute on this round, maybe wait for the next one, or just take my time. Are they going to close with another investor, and am I going to miss out on something big? And once you create that pressure on that entrepreneur, then you're the one that has the power in that discussion. And you're the one that can negotiate a better deal. You're the one that can, drive this process forward. So now we've talked, about almost all the different questions, all the considerations, and everything you're kind of gonna sit down and write on your investment, on your fundraising strategy, all the different parts. But now I think it's the big question: how do you actually execute on all these things that we've been writing down on a piece of paper? And I think it's best to start with, how it doesn't go and how it doesn't work. What's not going to happen is that you're never going to go, get in an elevator, find an investor, give them your 30-second elevator pitch. And at the end of the, as the doors open from the elevator, they're going to step out and give you a handshake and say, okay, yeah, you got my check. That it doesn't work like that. At the same time, there's not going to be, a set of Shark Tank judges waiting for you to pitch your idea. And at the end of this 5-minute pitch, 30-minute pitch or whatever, they're going to also offer you a deal on the spot. Really, raising capital is a whole process. It goes something more like this. You as an entrepreneur are going to first contact these investors, or going to get referred to them, or for some reason you and the investor match in terms of, and you send them, an intro email where it's going to be like, hey, I would love for you to learn more about my startup. Here's my pitch deck, or here's my one-pager. The investor is going to get this information. It's going to qualify it. Is it a fit for me? Is it the right stage? Is it the right sector? Is it attractive to whatever? Does it fit my investment thesis? If it does, then you're probably going to have a first meeting where they're going to try to get to know you, get to know more about your business model, and, just overall keep qualifying whether the startup, it makes sense for them as an investment. They'll take all that information and they'll go to their desk and start evaluating it, probably try to dig a little bit more in your market, just try to understand your business model, try to judge whether it's worth it to keep you in the process. If it is, then you'll probably have a second meeting, normally with the partners at the venture capital fund, someone higher up in the company, or with the broader team. And then they'll probably at that point just keep digging on your business model, really try to understand it inside and out, and ask themselves, should I put money into this company? At that point, if the answer is yes, then they'll send you a term sheet. A term sheet, just for a note, it's a non-binding offer essentially for some type of investment. It's not a contract, it's just here, this is what I'm proposing. Once the term sheet is accepted, the investor is probably going to start doing their due diligence, asking a bunch of questions, making sure everything's in order, really getting in deep and understanding your market, asking questions to experts, etc. You're going to have to provide them the information to do that. So you're going to have to give them your data room. They'll keep doing their due diligence, really read through everything you send them. They'll present it internally to their investment committee. Then if that's approved, they'll send, they'll do the final documentation signing. They'll sign the SAFE, they'll sign the shareholder agreement, whatever instrument you're using. They'll send you the money, and then you can celebrate. But between point A, where you contact the investor, and this celebration, there's tons of stuff that happens. It's not a straightforward process at all. One, there's probably going to be a bunch of back and forth between you and the investor as they ask you for more information. They'll come up with, there's always a million questions, and they'll keep sending you emails and say, hey, can you clarify this? Can you tell me a little bit more about X, Y, and Z? There might be some legal issues. When you send documentation, they might ask you to, make sure you have certain documentation that you might not have. So you'll have to talk to your lawyers, etc. And, from the investor's perspective, think about it. They're not only working on one deal, they're working on a couple ones. So there might be delays here and there where they might have to allocate, their attention to other parts of their work. So really, how do we make this process much more efficient? Because if not, it might get, if there's too many delays, it might just get lost. The opportunity might be gone. If it's just taking too long, then they might lose interest, or you might lose interest. Really, it's up to the entrepreneur to drive the process forward. The best thing you can do as someone that's seeking capital is not to wait for the investors to lead. You should be able to dictate the process and the timing. And, some investors will be unable to adapt to that, and they might fall short of your expectations. But most investors will if you're really pushing and really setting realistic expectations, then they'll try to work with you and meet your timelines. Especially if you show some urgency, and you might make them think, or they might be, missing out on a deal to competitors. It's always a good way to kind of, apply some pressure so investors keep the ball rolling. If you can create this momentum, it's going to be much easier to get it, back, towards that close at the end. If you think about the process itself, think about it also, it's always interviewing. Do you want to be working with someone that, doesn't reply for emails for a couple of weeks? If they ask you a question, and you get back to them 2 weeks later, and when they clarify you don't respond, they have to send a couple follow-ups. And in this process, until they send you the money, you're always interviewing. Investors are deciding whether they're going to trust you, and work with you for the next 7 to 10 years. So being responsive matters, and delivering on the promises that you make definitely matters. And the same is true for investors. If you don't hear from them for a couple of weeks, and you send it's totally okay to send them a follow-up and just ask for updates. They don't respond, think about it. Is this someone that's going to be, add value to your startup beyond just writing this check? Is it someone that, when you ask them for maybe a follow-on, are they going to, even respond to you? Or if you ask them for connections, if you ask them for any sort of value add, are they going to be at a point where they, they're going to be able, to deliver on that? So I think, think about this process, not just as the process itself, but also all the information you can glean for it, and push forward on it, and really pressure investors on the other side of the table. Not be extremely pushy that you push them away, but I think it's fair to really, drive this process forward, because at the end of the day, you want to get that capital as soon as possible so you can execute on that idea. Remember, at the end of the day, it's a process. So seeing that it's a process that you have to push forward, how are you going to be actually going to be able to manage it? If it's like a sales process. So manage it like one. Do you have the right tools to do it? Do you have a CRM? Are you automating as much as possible? Do you have things like your email templates ready? Are you working the investor list that you built? On the second step, we built this whole investor list. Are you actually talking to those investors, or are you just kind of ignoring the list and just going, here and there as you get intros? Be very conscious about, this process and how you're managing it, so you avoid losing out on time. Think about also how you're actually going to reach investors. When you're thinking about acquiring clients, you deep dive, on your acquisition channels. You probably compare, okay, how much it's costing me to get, customers through my Facebook ads versus my Google ads versus, referrals, etc. It's the exact same thing with investors. What's the best way, how can I invest my time and resources in the best way to maximize the amount of reach I can get to investors? What kind of message am I sending? You can test different templates, etc. Ask for introductions. That normally tends to be the gold standard in fundraising. So how are you exploiting, as much as possible your network in a way that you can get warm introductions? And finally, what are the rules of the game? It's your fundraise. You are not forced to take money from anyone you don't want to. So are you talking to people that it's clear why you want them to invest? How much are they investing? What's the minimum ticket size that you're setting? Are you looking for investors that can not only give you a check now, but also, are going to be able to, give you full-on funding in future rounds, etc. Make sure that you're setting those rules and sticking to them as much as possible so you can optimize your fundraising. And then finally, just a word of caution. I think it's really important, to have all the necessary documentation that investors look for before you fundraise. I think it's an integral part of your fundraising strategy. It's not just about designing the strategy itself, but making sure you have all the components for it. Specifically talking about the data room, make sure you have all the information that investors typically request of you. Do you have your KPIs, your cap table, all the information in your previous fundraises, a financial model, all the contracts? Your goal here is, to make it as easy for investors, to get information on your company. Sure, investors might come here and there and ask you, for something you don't have, and that's, I think, completely fair. You can always tell investor, hey, I'm gonna need a couple of days to get that. If they ask you for something specific that you shouldn't have, already organized. But in general, most investors at least are going to ask you for these core things. And it's going to save you so much time if you already have it, in a prepackaged, let's say data room that you can send them very quickly. So if they request it within 24 hours, they can be reviewing your information. If not, every time, if you don't have it organized, every time an investor makes a request or every time you talk to a new fund, you're going to have to scramble to get all the documents. And it's just not a good look if things are missing, if things are unorganized. Remember, it's kind of part of that interview process again. And just to finalize, some key takeaways. I know we talked about a bunch of different things, but ideally, all of these connects and really, helps you, sit down and think about, okay, how am I going to go about and fundraise capital? Some key takeaways is just, plan your raise, have a strategy that we've been talking about. It's a process, so manage it like one. Make sure that you take the time to, have the tools ready, have the information ready, but also have the patience. Don't get upset if you say, hey, I've been fundraising for, a month and I haven't gotten any answers. I haven't gotten even to the first meetings. It just naturally takes time. And I think it pays off to be very conscious about that and be prepared for that. Make sure you're targeting the right investors. If you're not getting any leads, if you are trying to talk to a bunch of different investors and they're all saying no, then maybe it's time to go back to the drawing table and say, okay, am I targeting the right investors for my stage, for my sector, et cetera? What could have been done better? Is there a better list that I can craft, et cetera? Have your stuff in order, when have the information ready to give at a moment's notice. So when they ask you and you have their attention, they're able to really go through your documentation. And finally, just pitch the deal. It's not just about, your business, what your business looks now. It's really about this vision, this opportunity. At the end of the day, we're investing in early stage companies because we want to see them grow and we want to, realize these huge companies and help entrepreneurs get to that point. So pitch that vision. Don't be afraid, to really, be realistic, but really show what your dreams are and why you're putting so much time and effort into these companies. And just to finish off, let's revisit this scenario where we talked in the beginning and, this investor had no plan. What does it look like? If someone comes in, if I just come to an investor who's prepared, who did their fundraising strategy and says, okay, I say, hey, so you're fundraising capital? They'll be like, yeah, I'm raising a 500K round. How much? Through a SAFE. How am I raising it? Through a SAFE round before the end of the year, which is when, from local angel groups, which is the who, to get to profitability and set up a company for scale, which is the why. So, this whole conversation could have just been one short paragraph when you're prepared, and it's probably going to have a much, much better outcome. So with that, that's most of the information I have. And I want to maybe leave the last 10 minutes to answer any questions you might have. Thank you so much, all of you, for your time.
Hello, Sebastian. This is Alex. Yes, we have a few questions in the chat. I don't know if you can see it or if you would like me to read them.
I can see them, yeah, but maybe if you go one by one, maybe just read them off, and then I'm happy to answer.
So we have Inaki, sorry if I'm not pronouncing correctly. How can you protect your idea during meetings with investors?
Yeah, I think that's a great question. I think a lot of times, entrepreneurs are really worried about, how, what if this investor steals my idea or, takes it, just takes it or gives information to my competitors. I think that there's a few things here that naturally, protect you as an entrepreneur for that. One, the fact that investors aren't necessarily, in the business of making companies. So I'm not going to turn around and, quit everything I'm doing, quit my fund and put in the time to really replicate your company. I think it's a little bit hard to do that. I think in general, it's frowned upon to ask, let's say, investors for an NDA before even meeting with them. Because, I think everyone would lose a lot of time. At the end of the day, investors see a lot of ideas. And even though you might think you have this very unique business model, most of the time investors have at least seen something similar to it in the past. So don't be afraid, to keep it high level, say the vision, but you don't necessarily have to spill your secret sauce in the first meeting or the first 5 minutes of the conversation, right? Just all you're trying to convey is, hey, this is what I want to do, and this is why I'm the right person to do it. And the investors are in the business of partnering with people that can do it. So if they have a trust, if they trust you, if they think this, you're the right person for the job, then there's no reason why they, should steal your idea or anything like that. So I think in general, it's just market dynamics. It's, maybe the question is, okay, how much can you reveal without, getting to a point where you just are an open book and someone can take the information.
Great. So now we have one that is more stage focused. So does it make sense to raise money from business angels before the launch of an MVP or official launch of the finished prototype?
Yeah, I mean, I think it's dependent completely on multiple factors. One, most importantly, let's say probably your business model. If your MVP is still something pretty big, then you might need capital. The question is, the earlier in the process that you raise outside money, the more equity you're gonna have to give, right? Because it's it's less structure, it's less of a real business, so it's probably going to have a lower valuation. So I think it's completely fair. And some business angels, some angel investors love investing in let's say pre-MVP or idea stage companies. Some won't do it. So I think at the end of the day, it goes back more so on the stage itself. Is like, do you need this money right now, or you just want it? If you need it, then are you okay with kind of taking the terms that they give you and maybe having to give up more of your potential upside in the future? And it's fine. But I think overall, yeah, it is fine. I do like to see it personally, and this is kind of like a completely different point, but I do like to see companies at least that are bootstrapped in the beginning, because I know the investor is going to be much more motivated at that point than if they just launched their MVP and they already own 50% of the company versus 70 or 80%.
Lovely. So I have three main questions then. One is a bit generic, but maybe you can give some references of good extra materials or sources of information to share this kind of knowledge and confidence in the process.
Yeah, I mean, I think there's tons of guides. I think what I like to read is mostly documents, mostly books that break down the process. So specifically, I really like Venture Deals and Secrets of Sandhill Road. I think those are two fantastic books, both written for entrepreneurs by investors, that really break down this process into very tiny sized bits, so it doesn't seem as intensive or as as big of a process and really breaks it down. At the end of the day, I think sometimes it's scary to raise capital and you think it's very overwhelming, but investors are coming from a very specific point of view. They have very clear motivation. So I think understanding how they think about the process can make it much more transparent for an entrepreneur.
Thank you. And then we have Walid, maybe, how the negotiation happens between the entrepreneur and the investor.
Yeah, I mean, I think it tends to be very casual. I think people maybe imagine, this whole, I don't know, boardroom situation or something like that. I mean, I think at the end, especially in your early stages, it's so much more about the entrepreneur and kind of their ability to execute than the vision itself, because we as investors understand the company is gonna change over time. So, these negotiations tend to be in general very friendly. No one's gonna ask you, for a draconian deal, and if they do, then it's probably not the right investor, frankly. If they raise any red flags, then sometimes it's better to not just take the deal because it's there, but maybe take a moment to step back and say, okay, is this someone that I really want to work with the next 10 years? Just as a point, maybe like an optimistic note, but something I truly do believe is that it's, yes, you are interviewing to the investor because they're writing you the check, but investors are also interviewing with you. And we as investors want to put our best foot forward because we want to be part of your cap table. And nothing's worse than, being with an entrepreneur that you really believe in their idea. You think that, they're doing great things, but because you weren't nice or, you were rude or whatever, you kind of overstep your boundaries in terms of kind of the deal you were offering or whatever, you lose out on the space on their cap table and there is from other investors, and you're out of the game completely, then that's not good at all. So it's kind of a two-way street. So I think it's also equally as important that entrepreneurs choose their investors.
I couldn't agree more, actually. And a few questions more. I'm gonna get group 2 questions, which is how to contact investors. So just send them a LinkedIn message, call them, email. And there's another question related to this, which is what do we do at this time? Do we send a pitch deck? What's the best approach? Yeah,
I mean, it changes. I think, in general, the industry has always, been one of where introductions tend to be the gold standard. So, you'll get referrals from either people other entrepreneurs. They'll just introduce you to their investors, and that's probably the best way, to get on the radar. I think in some ways the industry is moving away from that because, it recognizes that it's not always fair. But the reality is that, in general, investors are normally, gonna get much more deal flow that they can realistically handle. So I think trying to just, get to know them and get a warm introduction is the best, way possible. So that doesn't mean, hey, you have to have all these connections already. You can build them up, talk to different entrepreneurs. Entrepreneurial circles tend to be super supportive, and the people that raise capital normally, if they believe in your idea, they'll be happy to forward, make that intro to their investors. Go to places where investors go, so conferences, events such as the ones held by Bridge for Billions, stuff like that. I think that's a great way to meet investors as well. And then also just if you're cold emailing people, then just really refine your pitch. I read all the cold emails I get, I read them. And if you have a pitch deck that's I can review, or one pager that I can review and it's going to get me interested to get a meeting, then for sure I'm not going to turn someone down just because they didn't get an intro. So I think, it's at the end of the day, it's always going to be a numbers game. You do have to put in the time, and frankly, a lot of investors might not reply because it's not the right fit, or it wasn't the right time, or whatever. But that's just the rules of the game. And it doesn't mean that door's closed forever. You might get a warm intro at some point in the future, especially in emerging markets. Venture capital and investment circles and entrepreneurial circles tend to be quite small. So you do end up kind of knowing everyone at some point or another.
And then actually Jan is just asking about the book that we mentioned. I have the link and I just want to check, is it by Brad Feld and Jason Mendelsohn, or is it?
Yeah,
okay.
Yeah, Ben Trudell, fantastic book.
I'm going to share it in the chat. And then Peter is actually asking about the case, for example, for founders in emerging countries that do basically connections online and want to be sure about background checks for investors too, etc. So what could be some tips for this case?
Yeah, I mean, it's unfortunate that in certain countries, the investment circles aren't as developed. I think in general, though, like especially, I see the case here of Liberia. It's tough, but I think about, sometimes you have to think a little bit outside the box and think, okay, who could be an angel investor? Who would make sense? What's your, what industry is your startup in? Can I reach out to maybe successful people in that industry or get a connection to them? You can also think about, okay, maybe there's no investors in my country specifically or local investors, but is there a regional investor that makes sense to talk to? There's like a whole movement for regional, early stage investors. You also might think about, okay, what are some other sources of capital? Who's working in the innovation space in my country? Are there, any government programs? Are there any foundations that are giving out grants? Any development financial institutions, etc.? Try to just, I think it might be, a more upwards hustle than, if you were maybe in Silicon Valley where, there's a million venture capital investors. But I think that it's, I think there's always opportunities here and there, and I think you'd be surprised on the type of investors that you find. Again, I would refer you to maybe try to find successful entrepreneurs in your country who have been able to raise capital, and they tend to also be able to curate deal flow to other investors who just know them as references in their country, and ask them for referrals or the next big thing.
To be mindful, because I know we just reached 1 hour, I'm going to do one last question. And then I see some questions here around pitch deck and actually about the geography questions. So I can also advise that we have 2 more sessions within this series, and one is especially focusing in founders for emerging countries. So do ask your tips to Melanie, who works with founders mainly in Western Africa, for example. And then we have one last session, which is about the pitch deck and making sure that we know what actually how do we come up with all that information and what would be ideal in some suggestions of some scenarios. So do join, because it's going to be sort of a workshop. So I think it's a very interesting exercise to do too. And then Sebastian, I'm gonna just share Telly's question, which is how do investors feel about solo founders? And is there a bias toward multi-founder startups?
Yeah, I mean, I think that's a great question. I mean, to be completely honest, I think most investors that, let's say, have that bias towards, let's say, having a team of co-founders versus solo founders, base it on the fact that research has shown that co-founders do tend to outperform. I don't think it's necessary. I mean, we've supported solo founding teams. I think the question is why are you a solo founder, and can you justify that? Versus, can you bring maybe other co-founders, even if they're minority co-founders, into the team, in a way where they're gonna, maybe help you be more successful, complement your skill sets. Let's say, you're not a highly technical person. Are you, better served by having, a very technical co-founder, who can be your CTO or whatever, even if they own only maybe 5-10% of the shares. Versus just having employees that do it, who really, might not have as much of an incentive to stay with your company and really see it through the next 10 years. So, I mean, I think yes, I frankly, I think that bias does tend to exist with some investors. I don't think it's a barrier. We've seen multiple successful cases of solo entrepreneurs. I think the question is just, being an entrepreneur is really hard. And do you have all the skill sets that you need to really, take your company to fruition?
Thank you so much, Sebastian, for joining. It was such a resourceful session. I couldn't be happier. I hope everyone enjoyed too. Before we leave, I wanted to do the challenge. Can we just take a picture with our cameras on so we can share it then with the rest of the community? I'm going to do it myself. So sorry, just smile so everyone is in a good face. Okay, I see everyone turning the cameras on. Thank you. Yay. Thank you. And I really want to thank you, Sebastian. We do have those 2 more sessions. If you would like to share with your co-founders, with other people that is looking for support, the objective of this series, it's really for any early stage founder who is looking for this kind of support and this kind of tip that we usually don't get unless when we're already in the journey and learning by ourselves. So do share with them. I also shared in the chat Seedstars web, and you can find also Sebastian over our LinkedIn latest post. Thank you. I don't know if you have any other last comment, Sebastian.
No, just to thank all of you for listening to me. I hope this is helpful. It's always, a pleasure to work with entrepreneurs, especially all around the world. And yeah, good luck. Keep going. And like I said, being an entrepreneur is really hard. So I congratulate you all on all you've achieved so far.
Thank you. I hope everyone has the rest of a wonderful day, whatever you're logging in from. and if you have any questions, just let us know. We will also be sending the recording later. Okay. Thank you.
Awesome. Thank you all. Bye.